Hi, everyone. Thank you for joining us with Done with Divorce. We're going to be running our Discovery to Divorce webinar today, and we will jump right into it. So first, I just want to introduce myself. My name is Elise Finney. I am a private wealth advisor with Argent Bridge Advisors, and I'm also a CDFA. We'll talk about that in just a moment, what it is. And I'm joined today with my colleague, and her name is Alina Cannon. She's also a CDFA and also a CFA, and she is a divorce and investment strategist with Argent Bridge Advisors. This is a little bit about our firm information, and we will continue on and jump right into everything. So what is a CDFA? It is what we call a certified divorce financial analyst. This is a special certification process that a wealth advisor goes through in order to help those who are going through the divorce process. And our role in this is really just a lending support to both our clients and also their counsel. And we're really wanting to give our clients their full understanding of what their financial picture is, so that when they come out of divorce and as they're going through divorce, they can make decisions that they'll understand what those decisions are and more importantly, what the impact is in the long term in terms of their financial picture. So many things go into that decision-making process. And we're going to kind of talk a little bit about the steps today and what the short and long-term impacts are. So how to get started? That is a question people always want to ask us. Where do I start? Do we start with the attorney? Do we start with a financial person? Where do I get started? And it really depends on where the information is and how many eyes or how do you have eyes on that information? So if you're really going into something where you don't have any indication of where the assets are, or maybe the assets exist, but you don't have access to those assets and your spouse is not sharing any of that, then sometimes it's best to really start with your attorney and to go through that discovery process. If you already have the information and you have eyes on the accounts, you know how to get statements and access those, then often it's great to start with a financial person because we can help organize you before you even go in and seek counsel. Or you can start with counsel and then come back to a CFA and then move forward from there. So the whole purpose of this, beginning process and getting started is, again, finding out where the assets and the liabilities are and really being able to put that in a organized fashion so that when you are speaking to any professional, whether it's your attorney or anybody else, you really have information and it's very quick because you're spending a lot of money. As you know, it's not inexpensive to get divorced. And if you're spending a lot of money, you want to make sure that every minute that you're spending with your counsel, that you're being able to really get your hands on these important figures very quickly. So this will give you a sense of kind of just your overall picture of where your financial situation is, give you a sense of control, again, before and during and after the divorce. So what are we looking for? Where are we kind of sleuthing around? We want to really make sure that you have eyes on all of your assets. We'll talk about, actually, Alina will talk about that in a little bit, what assets are. We want to make sure that we've got our eyes on all of our liabilities. So it's going to be our debts, any of our income, any money that's coming into us. We want to make sure we know what's coming in as far as money on a monthly basis. And very important to know what your expenses are. And sometimes when you're working on your budget, you might not know what's going to happen during or even after divorce, but you can always start with a budget. You need to have, some base information. And then, the biggest ones that usually kind of vary will be maybe, am I going to own? Am I going to rent? Am I going to live in the place that I'm still living at a certain cost of living? Am I moving to a less or a more expensive cost of living? And those can be easily adjusted, but you need to start with some type of budget. And it's never fun. Doesn't matter whether you're going through divorce or not. It's never fun to get into a budget. And the way we kind of recommend that is just to really start with the last year through credit card statements and kind of averaging things out. And maybe in a circumstance where we have very high costs in expensive food costs right now, maybe you'll only be looking at the last, 3 or 4 months. Just want to get a sense of what you need to live off of coming out of divorce so that you can help make those decisions as you were negotiating. So lots of time when people are looking for where is the income, we'd be looking at a tax return. So tax returns are not going to show everything, but they're a really good base. We can sleuth around in those pretty easily and get our hands on, or at least identify where the income is coming from and some of the assets. It doesn't show things like retirement assets unless you're in distribution, but everything else in terms of income will show on a tax return. So that is very helpful. And you can go into the IRS website. If you don't have access, you can go back, number one, to your tax professional and ask them to send you copies, whether you were involved in the taxes or not. You were still their client and you have every right to ask for access to those documents. And then going to the IRS website will give you further access. You want to pull a credit report. This is important. It doesn't even necessarily mean that there's debt on there, but you're going to be tying loose ends up. So you want to make sure that you have an understanding of where the debt is and any potential joint credit card accounts that we want to be closing down the road. So, talk about kind of where are the funds coming from, and they may come from different places before, during, and even obviously after divorce, but we want to know where the money is, where more importantly, the liquid money is. So liquid money is, not retirement accounts, because there could be big penalties and obviously big tax liabilities that come with that. But where is the liquid account? What is going to get you to the finish line of divorce? What is that money that you are earning? Is it money that's sitting in a cash account? Is it other money that you might have access to that you can access? So we just want to know where that is and just have a good inventory of that. When we talk about, gaining control or get control of your share of the joint bank accounts, we're not necessarily saying, go into a joint account and cleaning out, half of the funds in there. We wouldn't want you to do anything without the advice of your counsel, but more importantly, just to kind of know what's in there. Again, just taking an inventory of where the assets are and what type of lines of credit you would have and things like that. So obtaining credit cards in your own name. If you've only been the secondary person on a credit card, it's important while you're still married to establish a credit card in your own name, because it may not be as easy when you don't have income, because there might be a period of time where you maybe will be returning to work, but you don't necessarily have income, or you're going to be relying on support, but that's not necessarily income you can count on in terms of saying this is happening every month, even if the person's giving you, money every month to live off of, until you actually have that in writing in an agreement. It's not technically income. And so it's important to be able to establish something in your own name so that you can build your own credit. So one of the things we're always telling our clients to do, and this is hard, and we understand that it's hard, but the reason why it's important to kind of separate your emotions from the finances is because as you're going through this decision process and deciding on things that are going to be affecting your life post-divorce in terms of your finances, you really want to be able to kind of, again, just separate those emotions, because you want to be able to focus on the things that are most important to you. We know that divorce is not fair. There's no winners in divorce. I've heard, former judges even talk about that. Nobody comes out of divorce saying, I won. You're going from a household that had, potentially 2 incomes, and now all of a sudden there's one. The assets are divided, not necessarily in half, but certainly they're divided. So nobody's going to be winning in that situation. And it's really important to kind of just separate everything from the finances so that you can make these decisions, again, focusing on what's the most important thing to you. And there's lots of people that can help you in that process. We're based out of Northern Virginia, but wherever you are, I can promise you in today's world, there is some really fantastic divorce professionals, and whether it's a therapist or a attorney, financial people, tax professionals. There's so many great people that really know how to navigate you through divorce. And it's important to really seek out the unbiased professional advice. It's great to get advice from your friends, but it's clouded in some way. Obviously, they're team you, and you want to make sure that you're getting really unbiased professional advice and not really even compare your situation to someone else's. If you have a friend that went through divorce, they'll say, well, in my agreement, I had this, and it's really nice to hear those things because maybe it makes you feel better in that moment, but really important to kind of identify that your situation is unique and you want to make sure that you're getting the best professional advice in that process. So when we talk about, what is important to you, really just focusing on, what is a dollar and dime issue. So in often cases, this might be, a big dollar issue would be maybe the marital home, where maybe something smaller would be air miles. We've seen people get, tied up into these, smaller asset values, and they really start, it can cost you even more in a different way because you're having to work through this negotiation through your attorney. And sometimes it's not even worth the value of the asset. So just really important to say, like, hey, what's my top 3 things I need to wind up coming out of this divorce? What's the most important thing? And really being able to negotiate from there. So we always tell clients to, take control, really just take an active role. If you have never been in that active role in your household, it's okay. You're going to be starting from a place of experience, not starting over. And so, you probably know more than you think, number one. And then also, this is just your opportunity. I mean, you're kind of forced in this situation, into this role right now. So it's really time to kind of take the reins and really understand your financial situation. It's very empowering. And again, there's lots of professionals that help you understand. You always want to understand where the money's coming from, where the money is, and where the money is going out. It's very important to be able to understand what that process looks like. And most importantly, again, you'll just feel really empowered by that, so that when you're making those decisions, you're not going to be just accepting something, because you don't understand or you feel powerless. Want to make sure that you are really taking control here. And there's no better time to start than now, even if you haven't been involved. So I'm going to turn it over to you, Alina.
Thank you, Elise. So earlier, Elise referred to the discovery process. So in divorce, you are required to fully disclose all of your property. So that's assets and debts. And in divorce, property is kind of classified. It is classified into 3 different buckets. First, there's the marital property, and that essentially it's whatever was earned during the marriage. Then there's separate property. And separate property is what was essentially brought into the marriage and kept separate, and not what is known as commingled, which means essentially like mixed in with marital property. So it may have like changed the nature of the property. So separate property that was brought in and kept separate, or gifts or inheritance, those can also be classified as separate. And then the same thing applies with, they have to be kept separate, not commingled with marital property, really like keep that nature, keep that classification. Also, what's really important to know and keep in mind with separate property is the burden is really on the one that's claiming the separate property to prove the separate property. And oftentimes there's assets get classified as hybrid property. And what that means is part of the asset, part of the account may be marital and part may be separate. A good example is a 401k. If, for example, you were married for 5 years, but you were employed with your current employer for 10 years. So that means that likely the first 5 years you're employed with your employer, that 401k, that portion is separate. just because you got married, your employer most likely did not start a new 401k account for you, right? You continue contributing to that 401k, your employer continued contributing to that 401k before the marriage and after the marriage. So that is an example of the 401k could be considered hybrid property. And if the 401k is your property, for example, then the burden would be on you to do that tracing to figure out what portion is separate. And in some states like Virginia, growth on separate property is considered separate. So back to that 401k example. So the balance, the date of your marriage and that 401k, that's considered separate in Virginia. And then growth after marriage, that's also considered separate. And in some cases we've had with clients, the growth on that separate property on that 401k balance can be pretty significant. So that's where it makes sense to really do that separate property tracing to really get, the separate property classification on what you could be entitled to. And then to dive a little bit deeper into the different types of assets, Elise touched on this earlier, but the different types of assets, really, we look at, well, all types of assets, but first there's the financial assets. So, like checking, savings, money market accounts, brokerage, which are investment accounts, stocks, bonds, retirement accounts, right? The 401ks, the IRAs, pensions. We do present value calculations for our clients that have pensions. Personal assets with significant value, right? So cars, trucks, boats, business. If there's a significant business involved, sometimes it makes sense to do a business valuation. So next, we want to actually walk through what a property report could look like. This is an example of a property report that we this is essentially what we create for our clients to help them in their divorce, in their negotiation process. And this, I think Elise alluded to this earlier, is just really laying out the financial picture, the property, the assets, the debts. This really helps. This is a great starting place really for your divorce negotiations, regardless of which path you go down, if it's litigation or negotiation or mediation. But looking at this example, so at the very top, we have Mary and John's sample, and they have a house, a marital home, 100 marital home lane. So this house, its value is around $2 million, and it has a mortgage around $400,000. And Mary had $100,000 that was classified as her separate investment into the home. So she was able to prove that with her tracing. So we have that reflected here. So that leaves 1.5 million remaining. That's the marital equity that's in Virginia, subject to equitable distribution. So you see the 1.5 million over on the right in the total amount. For cash and investments, excuse me, they have a joint investment account at around $500,000 and company restricted stock valued at also around $500,000. So about $1 million in cash and investments. Mary has a consulting business, but all of her revenue is income. So there's no value placed on the actual business. Then cars and personal effects. So Mary has a Volvo, it's valued around $30,000. John has a pretty new Tesla that's valued around $70,000. So together their cars around $100,000. They do have one life insurance policy. There's no cash value, so it's likely a term policy. And it's good to know when we talk about support, we'll go a little bit more into why life insurance matters. But total non-retirement accounts, they have about 2.6 million in equity. Then in retirement, John has a 401k valued around 600,000. Mary has a SEPA also around 600,000. And John has an IRA valued around 700,000. So they have 1.9 million in retirement. There's also, John has a pension at IBM valued around $500,000. So their total retirement is 2.4 million. So it means their total assets is 5 million. There's also a $20,000 loan on Mary's Volvo. So their combined total marital property is 4.98 million. So this is just like a really great place to start with negotiations, like I mentioned earlier. And then the two columns in the middle, you'll see they're not filled in right now. But when it comes to negotiations, so either if it's like lawyer assisted or in mediation, that's where the spouses can go in with support, of course, counsel and CDFAs. They're on the support team to like really decide who wants which assets, what is the equitable split of the assets, right? And we can go on to the next slide and dive a little bit deeper into the marital home. So the marital family home is usually it's usually the largest marital asset. And there's a lot of hard questions and hard decisions that need to be made when it comes to the marital home. The biggest question usually is, what do we do with it, right? Should one spouse keep it and buy out the other? Should both spouses sell it and split the equity 50-50 or some other kind of equitable split based off of like the other assets that the spouses have? So when it comes to like figure out if you can really afford the marital home, you also have to think about if you do keep the marital home and buy out the other spouse, can you really afford to do that? So if you do that, you'll likely have to give up other assets. Sometimes if you keep the marital home, you may have to give up more retirement assets. So just think about, is that something you're comfortable with? What does that look like? If you're giving up more retirement assets to stay in the marital home, that could potentially mean maybe your lifestyle in retirement is going to look a little bit different. Maybe that means that you may need to work a little bit longer in order to maintain the lifestyle that you want in retirement. How does that feel? So it requires a little bit of like reflection, thinking about like values and goals. When thinking about like, do you want to stay in the house and buy out your spouse, or do you want to sell the house, split the proceeds, and find a new residence? There's also some creative solutions that we've helped clients with too, where it's a little bit of a hybrid, where maybe one spouse stays in the house for 6 months, a year and a half, and then sells the house, splits the proceeds, and finds a new residence, right, to start their next chapter in. If you do decide to stay in the house, most mortgages are not what's called assumable by one spouse. Most of the time, there are a few exceptions. A few mortgages are assumable, so it's always great to check with your mortgage lender. Most mortgages, though, do require refinancing in order to take one spouse's name off of the mortgage. And so if you do want to stay in the house and keep only your own name on the mortgage, it's really important to understand if you will qualify to refinance the mortgage. So that comes into question, how strong is your credit score? That's what Elise was referring to earlier, why it's really important to have your own credit, build that credit history, so you can qualify for credit like a mortgage. It also calls into question income, right? A lender is going to look at like your income sources. So for sometimes a lower income earning spouse, support payments can actually be used by lenders to qualify for income. And what lenders like to see is if they're counting support, so it could be child support, it could be spousal support as income, they like to see 6 to 12 months of consistent support payments, so historical support payments. And then they also like to see that those support payments are going to continue usually for another 36 months. And that usually is supported with court orders, the settlement agreement, or the final divorce decree. Something else really important to remember when it comes to the marital home and potentially selling the house or thinking about selling the house is taxes, right? So if the primary residence is sold while it's in both names, so both owners, both spouses are owners on the house. So each spouse can exclude, per the IRS, up to $250,000 of capital gain on the sale of the primary residence. So together, collectively, they can exclude up to $500,000, right? $500,000 in capital gain. So this is pretty important, especially in this Northern Virginia area that we are in, Northern Virginia, greater DC area, where house prices are expensive and there is a lot of appreciation. Recently, there's been a lot of appreciation. So this is something definitely to consider when thinking about if you want to sell the house or stay in the house. If you stay in the house and there's over $250,000 of capital gain, then that's something that you may have to pay like taxes on later when you eventually do sell, potentially as a single homeowner. It doesn't mean you're going to pay the entire $250,000 of gains. You're just going to pay your capital gains rate times whatever that capital gain is above your exclusion amount, but it's just something to consider. And then moving on to retirement assets. So when thinking about dividing retirement assets, there's a couple of things to consider. First, with qualified plans, what that for the most part means plans like 401ks, they usually require what's called a QDRO, a qualified domestic relations order, to divide. So this always, I say, it's best to check with your plan administrator, understand what's really required to divide your retirement account, divide the 401k. It's best to always do this before that settlement agreement is signed, just to ensure that settlement agreement reflects what is actually possible. And then the other thing with the QDRO to keep in mind, it's a court order, so it takes some time to draft. It costs money to draft, and then it takes some time to execute. So IRAs, they usually don't require a QDRO, but same thing here. I still recommend just checking with the plan administrator before finalizing that settlement agreement, just because if you do want to divide it in one way, shape, or form, however you want to divide it, whatever you reflect in your settlement agreement is consistent with what the plan administrator will allow. And then federal retirement plans, they don't require a QDRO, but they require something very similar. It's similarly just a court order that specifies how the plan will be divided. So same thing here. You definitely want to check with the plan administrator before finalizing your settlement agreement. If you do decide you keep your retirement, your spouse keeps their retirement, then obviously there's no need for any of these court orders or any of these considerations. But of course, if you do, then just need to keep that in mind. And then pensions. So pensions, you kind of have a couple options. Pensions, you can split the benefit when it starts being paid out, or you can do a present value calculation. And that's something we can help you with to help figure out what is today's value of the expected future benefit of the pension. And if the pension, sometimes it's all marital, sometimes it's what's considered hybrid, which we talked about earlier. And so if it's hybrid, there's some portion that was earned during the marriage, some portion that was earned before the marriage. It's hybrid, then we can apply what's called a coverture fraction, which is just a way of really assessing and valuing and calculating the marital portion separate from the separate portion. And tax issues in divorce. So when looking at the property, all the accounts, it's always important to think about tax considerations. A checking account, right, probably doesn't have any tax implications, whereas a brokerage account that is holding stocks and bonds probably does have some tax considerations. But when you transfer title between spouses, so if you're just holding the assets, for example, if you're just transferring title of stock, right? You have a stock account that's going from one spouse's account to another spouse's account, incident to divorce, not selling, just transferring title. That is not a taxable event. The IRS has some code that says if it's just transferring incident to divorce, no tax implications. But if there's actually a sale of investments or withdrawal from a retirement account, if it's not done per IRS, well, if there's just a investment sale, then that is subject to tax. And then the retirement distribution, that can be subject to tax if it is not in the divorce decree, and also like doesn't follow what the quadro says. So it's just very important to be very cognizant of tax considerations when thinking about selling investments or withdrawing from retirement accounts. So moving on to support. So spousal support in Virginia. So there is no hard formula for permanent spousal support. There is what's called a pendente lite calculation for temporary spousal support in Virginia. And for the most part, spousal support is really based off of the relative incomes between the two spouses. And it's really based off of the higher income earning spouse's ability to pay and the lower income earning spouse's need for support. And when showing need, that's where it's really important to have like a really good, robust budget that shows that need. And the other thing to keep in mind, as of 2019, January 1st, 2019, spousal support, it's not taxable to the payee, and it's not deductible to the payor. It used to be, but not anymore. And for spousal support, generally, it's paid monthly, but there are a couple options. You can decide to do a lump sum payment for spousal support, and we can help with figuring out what the present value calculation is for that lump sum payment, or a hybrid option too, where there could be potentially a small lump sum and then potentially a higher amount, maybe in year 1, year 2, year 3 could taper down, year 4 could taper down further, and year 5 could taper down even further and down to 0. So there is some room to be creative with spousal support and what really makes most sense for the two spouses. With child support, so child support is based off of a formula. It's state specific. And the considerations for child support are incomes of both parents, parenting time, and what's really important there is the number of overnights that the children have with each parent. Spousal support also gets factored into the child support calculation, as well as the medical insurance premiums that are paid for the children, as well as work-related childcare. That cost gets also factored into child support. And child support really is intended to cover really what's called like normal expenses. So kind of really bare basics: food, shelter, clothing. Other expenses, because kids are not cheap. They're obviously not cheap. So things like out-of-pocket medical, extracurricular activities, those usually are covered as separate items in like a settlement agreement or a divorce decree. And those expenses usually get split either pro rata by income or 50-50. And child support, now similar to spousal support, it's not taxable to the recipient, and it's not deductible by the payor. So we wanted to walk through an example that just showed the impact of support payments and show how like tax plays in. So back to Mary and John's sample. So Mary's income is $10,000 and John's income is $30,000. John pays Mary $1,000 a month in child support, and then $2,600 a month in spousal support. But the important thing to note here is Mary is not paying taxes on that 1,000 child support or the 2,600 spousal support. And John is still paying taxes on his $30,000 of monthly income, and he's not getting any deductions for his child support and spousal support. So when looking at their taxes, that's line 5, it's the 2,000 that Mary pays and 10,000 that John pays. And looking at their income after taxes, so Mary will have in line 6 about 11,500 and John 15.8 thousand. So between the taxes and the support payments, that helps essentially make income a little bit more equitable for both Mary and John. And you can see that too, right? If you look at the chart on the left, you see Mary in that dark blue, and then John in that bright neon green. There's a big discrepancy between their incomes. But over on the right, we have Mary with spousal support and taxes reflected in that magenta color, and John in that light blue color. And then their incomes after taxes and after support, their net incomes are a little bit more equitable.
Great. Okay, we're going to be moving on to how do we protect that spousal support that may be coming into you. So one of the ways to do that would be through the purchase of life insurance. You may already have life insurance. You always want to identify, do we already have a policy? What type of policy is it? Is it a whole life policy, which means it's building up and has a cash value? What is the death benefit of that policy? Maybe it's a term policy. A term policy means that there's no cash value in it and it will end when the term ends. So it might be a 10-year, 15, 20-year. Lots of times people purchase them to get the kids out college, so you've got, these big expenses. So while your kids are in college, you're going to have expenses, obviously even younger than that. And then, the offset that your growth has grown. So that's why people often will time it to that, which will be, maybe 10 or 20 years, depending on when the term policy was purchased. So it's important just to identify what those policies are, what they are, and then also look at how much life insurance you have, because we're going to be using potentially life insurance to protect the value of this support that's coming into you. So maybe over the course of, 10 years, you're going to be receiving $100,000 a year. So that's $1 million worth of income that's coming to you. If that person that is paying the spousal support, it ends upon their death. So if they pass away, you are 2 years into your support, it's $800,000 that you will not be receiving anymore. So you want to, and you plan that way. You plan to have this income coming in to you for every year for the next 8 years. So want to make sure that we're protecting it in some way. And often life insurance is the way to do that, and an inexpensive way to do that. And you want to start off as early as possible, because identifying, you can't go to, we're about to sign our final settlement. Oh, by the way, I want to have life insurance in there, because it does take time. It may be that the person can't even qualify, but you have to run quotes and go through a underwriting process. So it's not a quick process. So the earlier in the process during your separation, you can identify if there's going to be a need for life insurance to protect this, then you want to make sure that you're starting that process early on. It's important to know that there's an owner. So that's somebody who owns the insurance policy. Then you have someone who is the insured. That may or may not be the person who is the owner of the policy. It may be the spouse. Then you have the beneficiary. That's the person who's going to be receiving the death benefit. In most cases, obviously, we're trying to protect this with life insurance. You want to make sure that you're the beneficiary of that life insurance. You may not be the entire beneficiary. The policy might be $3 million and you're only entitled to 1.5 worth of support. So it may be a beneficiary where it's a split, you, and then maybe the other 50% is divided amongst the kids. So it could be a situation like that. Then we have something called an interested party. An interested party is somebody who just comes onto the policy, that just gives them eyes on the policy to make sure the policy is still in force. The best case scenario is always for you to control the payments on this account, on this policy. You want to make sure that if this policy is there to protect you, you want to make sure it actually gets paid. So it's and not always able to, but it's important that you actually become the owner of the policy. But if you can't be the owner of the policy, then you at least want to be an interested party. That way you can at least identify that this policy is still in force. And if it's something through work, maybe you need to have the other person, it might be written into your agreement that they have to provide that every year that they still have this policy, make sure it's in place. It is often where, especially during the separation period, where spouses will cancel life insurance and it's hard to get that back. So just want to make sure that you understand that. And as I said, ideally, you're the person that's paying for the premium, because then you're obviously guaranteeing that the premium was paid and that the policy stays in force. So something to consider, and depending on where you are and what your age is, obviously Social Security may seem really, really far away, but it may not. But one thing just to kind of know and just put in the back of your mind that if you have been married 10 or more years, and that's up to the time you actually get divorced, not just separation. So if you've been married 10 or more years, you are able to collect on your husband or wife's Social Security. And that may not be the best benefit to you, but you do have the ability to do that. So you would only do that, obviously, if their portion is greater than your own. So if you have been not working for a long period of time, it may be that the other person's benefit is larger than yours. So what you would receive, again, this is only for someone who's been married 10 or more years, is 50% of your former spouse's benefit or 100% of yours. So it's one or the other, it's never both. Sometimes that somebody has a pension, government pension, most often we'll see sometimes it's even a disability policy, something like that, where somebody gets an offset for divorced spouse benefits. That means that if they're receiving money from another source, they would actually get less. Like if they're receiving maybe $500 a month from a disability or pension, then it would be offset, meaning you would receive $500 less a month in Social Security. So those are just all things to look into, to consider. It's never too early to go in and register for your Social Security. And you always want to make sure that that's up to date, that all your income over the years is getting captured, because it's based on capturing all of that. And if you're going to the policy or going to your statement, and you're missing 10 years, it's really hard to go back the IRS, Social Security Administration, and be able to prove that you had, back 30 years ago, that you had the 10 years worth of income. So we definitely want to stay on top of that and check it every couple of years. Effects of remarriage. So as I said, you would receive the possibility of Social Security from your former spouse if you are been married more than 10 years. But if you remarry before the age of 60, then this would disallow that. So if you are thinking about remarrying, you just want to make sure you know what the rules are. It may be if you're 59 years old and you're thinking, I really want to get married, but maybe based on the way that the Social Security comes out, you are better off collecting from your former spouse and you want to actually wait the extra year and wait till 60. So just things to just think about as you're moving on post-divorce. So death of a former spouse, this is an opportunity where people can actually take the full amount of the former spouse's Social Security if they've passed away. So maybe you don't want to see that spouse and know what's happening in their life, but you at least want to know if they're alive or not, because it may wind up being a little bit more money in your pocket from Social Security benefits. So we're always talking about financial considerations and moving on with divorce. And we do have another webinar that kind of addresses these things, which is just our strict done with divorce, as opposed to this one more about discovery to divorce. And the reason why we want to focus on all of these things and kind of just put it into your back of your brain a little bit is because as you are coming out of divorce, again, this is your opportunity to get, your financial life, get everything in order and really understand how to move forward from a financial aspect. And then most importantly, when you have this agreement, you've signed it, you're exhausted, you've been down to the wire negotiation. it gets submitted in, and now it comes back signed off by the judge, and you're thinking, okay, what now? What? I have this agreement and I don't know what to do. So it's always good to work with a financial professional, because the first thing that we would do is map out everything for you. We would map it out, put timelines, so you would know what is your responsibility to do. If there's any type of assets being split that you're the owner, what paperwork would be required, how that would work. And if you're even the person who's receiving assets, you can't just, receive a retirement asset without having an account open. So we need to identify, opening accounts, what type of accounts need to be opened, and then what is the responsibility of the other spouse, how that money is going to transfer. It may be a property. It could be, coming off of a mortgage. Again, Alina talked about the whole, refinancing, maybe, coming off deed. By the way, coming off a deed and coming off a mortgage are two separate things. So you want to make sure you understand what those implications are. So always wanting to be understanding what is in that document and how it's going to get executed, especially when you get around the whole quadro, time framing on that. Because the longer you don't have control over your assets, you're not in control of them. You don't know how it's invested, and there are some risks, and we're not trying to put fear into you in any way, but just be aware that if the person, you have this divorce agreement, and the person, passes away the next day or becomes disabled and is not able to actually sign off on this paperwork and transfer these assets, you may be waiting for your share of your assets longer than you want. And obviously, if there's a need, it's very important to kind of keep that ball rolling. So you always want to pause, think about it. And it's hard to come out of divorce and think about, where am I going to be in 5 years? We just originally just want to look at that first year. Like, what does this first look like? What are the expenses? What are the initial things I need to consider so that we can be planning for all of those things? So you just want to look at coming out of divorce, these like smaller little increments of time, and that will help you make those decisions. One of the things that we cover in the other webinar is estate planning. Estate planning is so important. It's important as a married couple. It's very important, even more important as a single person, because a lot of assets that may have been jointly owned, that would transfer to the other person. Now this is all individually owned, and we want to make sure that this is set up properly so that assets can transfer in the case of anything happening to you. And especially if you have minor children, super, super important to make sure all of this is outlined in proper legal documents. You might have a trust. You're going to assign, what happens to me if something happens to me, who's going to manage that money? Because I don't think you want your ex-spouse managing money on behalf of the children. You probably don't want that person involved at all. And you could appoint somebody else that would be financially responsible for the children. These would, of course, be considering the assets that you have. So again, we can't stress it enough, just that importance of getting good professional advice. You want to build a team. This is all about your time to build that team. And all of these professionals should be working, closely together. And I know that for our particular firm, when you engage with us, we always ask, is it okay to share this information with your attorney or your tax professional? Do you want us to? How much do you want us to share? You are in control of this process. You want to make sure that you understand it and that your divorce professionals are communicating with you or communicating with each other. It's very common that we will be working with client and then say, hey, let's jump on a call with your attorney. I want to make sure your attorney understands, where our thought process is coming and why these recommendations might be there. So just to kind of close this out, we are part of a nonprofit organization called Done with Divorce. We are speaking on behalf of ourselves today, both Alina and myself, for the firm that we work for, which is Argent Bridge Advisors. And for our firm, we always offer a 20-minute consultation, complimentary consultation to anybody that might be going through divorce, kind of wanting to know how we engage with clients. And we are happy to do that with you. So if you want to scan the QR code there, you can set something up with myself. And if you want to just email or call, all of our information is there. So we really appreciate your time today and really encourage you to explore the other webinars that we have, all these on-demand webinars that we have put together for our Done with Divorce nonprofit. We spent a lot of energy and time getting the best professionals to come and give up their time to you. So I hope this is helpful. Thank you.